What's up, everybody? Welcome to another episode of the Chart Book. It's been a little while, and as 2020 is finally winding down, I don't want to jinx it. We still got a few weeks to go, but we can see the light at the end of the tunnel. I'm here at the Sanctum Sanctorum. I think that's how you pronounce it for the comic book nerds out there. We're going to run through a bunch of charts today, so let's get started. What we talk about? Well, this has been a weird year, certainly already, but it's kind of fun to rewind as we look back at the beginning of the year. Here's a fun tweet from January. Feels like 10 years ago, but I pulled this quote out of Barron's, where a very famous money manager, I'm not going to say who, but his name rhymes with my belly, $40 billion in AUM, probably more, had a quote that said, "The markets will be up in the first half of 2020 and turn down in the last 90 days because there will be a lot more uncertainty for 2021. Now, how this manager could say that, A, with a straight face, or B, with this amount of confidence, and still manage this much money is sort of beyond me. Part of me understands that he's just playing the game of telling investors what they want to hear, which is confidence and certainty. But at the same time, we all know that forecasting the future is impossible. And it's just unfortunate to see people say things like that because they know there's no chance of predicting the future. You have Nate Silver, who, has his detractors as well as his proponents, but he had a good quote at least where he says, "I spend 90% of my time thinking about the thing that will happen 10% of the time." Now, he said this with the fullness of 2020 already and benefit of hindsight. But as investors, this is the way you need to approach markets. And most people don't consider the outcomes of the 10%. They extrapolate the recent past into the indefinite future, and that's where they often get into trouble. 2020 is a great example. It's a reminder. It's not something that's totally new. You've had markets like 2020 many times in the past, but it's a reminder of the returns are not normal. They can be extremely volatile. And here's a tweet back from March. And just to show you both sides, I mean, if you recall, it felt like the zombie apocalypse. The depths of March, we were pretty close to printing the worst month in U.S. stocks in the last 120 years. It was down 30 in 1931, and small cap value was even more getting eviscerated, down a third. At some point, I think peak to trough was down 50. But I said, look, it's good to take a step back and see at least what happens during these really bad times. We actually published a similar study in our old Ivy portfolio book over a decade ago. And we said, what happens after these really bad months? And if you look back at the top 10 worst stock months, which were all over minus 15%, many were in the 30s, the Great Depression, sprinkle in 1987 crash and a little 2008. But it turns out the future returns on average after the 10 and 20 worst months were 30% and 15%. So way outsized positive returns for investing in the really bad times, but it's not guaranteed. There was a haymaker, you went down another 2/3 at one point. Similar for small cap value. You can go look this up yourself on French Fama data. REITs, by the way, almost printed their worst month ever. But the point of this being is that if you don't look at what's happened in the past, you don't at least have an anchor. So when everyone's losing their mind in March, and we wrote a companion piece called Investing in the Time of Corona, and said you had at least to consider the possible positive outcome, and you lay out the scenario of the bull case and show what could have happened to take markets to all-time highs by the end of the year. And sure enough, here we are. But as you've seen U.S. markets romp right back to all-time highs, and markets have a way of looking around the corner, right? You have people getting giddy, which is where we are. And this is a survey that caused me a great amount of angst, triggered me a bit, where it was from Schroders, who polls people every year. And usually they say, what do you expect your portfolio to return in the next 5-10 years? People almost always say around 10%. Well, this year we had the special privilege as Americans of having the highest return expectations of anyone in the world at over 15% per year, which I can't say is impossible, but would probably say is incredibly unlikely situation. The historical average is below 10%, by the way. And has there been times when you get a 15% return? Sure. But valuations are a bit stretched. The U.S. has beaten everything else in the rest of the world. So probably unlikely. But I love looking at these polls because often the polls are wrong and often wrong at the exact wrong time. So here's another poll winner. This was from October, again, after the US has had this massive run. And it says, what asset classes do you consider most attractive? And everyone said stocks. And then which major stock market will perform best? Of course, everyone said US. What was last? Europe and Japan, which, to note, by the way, have been romping and hitting new all-time highs in Japan, which take 30 years to happen. Incredible, right? Biggest bubble we've ever seen in the 80s. Japan stock market hit a PE ratio of almost 100. Took them 30 years just to get back to even. But no one wants to invest in Japan because it hasn't been as exciting as the US. And certainly no one wants to invest in Europe, which has many of the cheapest stock markets in the world currently. And then, in my opinion, is one of the most attractive regions across the globe. What else do you see during the good times? Well, you see people start to get a little aggressive with their risk. 2020 has seen the resurgence of a very old structure that has been around for hundreds of years, the blank check company, otherwise known as SPACs. SPACs have had a long history, a long checkered history. And as everyone is piling into them, it's at least good, again, to know your history and say, well, what have SPACs done historically? And it turned out, if you look at the short history of almost 100 SPACs since 2015, and this is from Renaissance Capital, the median return was down 30%, so not particularly good. Our friends at Luthold, who've been on the podcast, have showed that they went back even further and looked at a bunch of SPACs and found that the median was post-IPO minus 70%. And I said, I haven't seen a greater wealth incinerator in one category than something like this. And you can see the price chart here and go long, look at what some of these are. Now, let me distinguish between SPACs where you can buy pre-deal announcement and have the floor of potentially getting your cash back to actually buying the SPAC upon announcement of and completion of the IPO deal, which is totally different. A lot of incentives to get the deal done. If you don't know anything about SPACs, a great podcast for you guys to get some background is the Julian Klimachko from Accelerate. We've done 2 with him. And he talks about a totally different trading strategy than just going long SPACs, which is called SPAC arbitrage. Really helpful walkthrough on the Faber Show podcast. What else is 2020 wrought? Well, here's a good example, and this is a little tongue-in-cheek, but the FT had a chart of value drawdowns, and this is, I think, long, cheap, short, expensive. I don't know how they figured this out in the 1800s. Maybe they just used dividend yield. But even if you did 1900 forward, or just the French Fama data, everyone knows that value has been struggling the past handful of years, and you're setting up for potentially one of the biggest periods of value underperforming growth and market cap weighted indices. So going back to the Nate Silver approach, is that something that you just expect to extrapolate forever into the future, that growth is going to beat value? Probably not. Another big casualty, energy, which used to be at one point peaked at 30% of the S&P 500, is down to, I think, sub 3% of the S&P 500. It's in a massive drawdown of over 60%. If you guys remember, see if I can even find it real quick. We did a study that looked at buying sectors and industries down 60, 80%, and found that if you closed your eyes, held your nose, this is back in 2013, that usually future returns were great. And again, you can go download the free French Fama data and play around with it on your own, but 3-year rates when buying a sector or industry, when they're down 80, 90%, are pretty darn strong. And the same thing for a country. So these are hard to do. Obviously, no one wants to buy things that are down low. And that's when you get cheap P ratio. Usually it's simply the P that's gone down 80, 90% rather than necessarily the earnings. So good news is there's a lot of sectors like that around the world. So here's a good example from Ben Johnson at Morningstar, where he talks about MREAM, mean reversion rules everything around me. In the first chart, he's got by year the best performing ETF. It looks like annual return, many in high double, some triple digits. And then what the future 3-year returns were, and pretty subpar. Last year was Solar, the year before Qatar, ARC. And then vice versa, he looks at the worst performing. So many of these down 50% printing in a year. These are non-leveraged, I believe. And then subsequent 3-year returns actually pretty strong. And this has been dominated by the past 6 years by agriculture, energy, what else in here? Some coal sprinkling in, solar, small cap Russia. Anyway, that's a good place to at least go prospect a little bit. The interesting thing about some of these surveys, and we love doing these polls, which we'll touch on a few too, is it helps check your bias at the door. And in some cases, the polls, we have one back in like 2012, where we were talking about the US 10-year went below 2% for the first time in this cycle. And we compared it to Japan and said, look, these things can go down and down lower for longer, for far longer than people expect. And we talked about a poll that was showing, what asset classes people were most interested in. No one wanted to own bonds. Bonds have been fantastic for the past 10 years, despite having a low yield. And here's a great example. This was in Barron's in October. And they said, where do you expect the 10-year treasury yield to be a year from now? And I'm not saying it's probable. I'm definitely saying it's possible, but not probable. But at least you have to consider, with most of the world's sovereigns already trading negative, that negative is a possible outcome. And this Barron's poll didn't even consider it a possibility. Nearly no one expected rates to be below 50 basis points. So we'll see. Maybe they normalize where they are, but you have to at least consider that. And if bonds do go negative, it's interesting to think about, because as you do the playbook from this past year, what really helped hedge markets during the downdraft this past year? REITs didn't help, foreign stocks didn't help, bonds helped, commodities didn't help, tail risk certainly helped, trend following did okay, but bonds didn't help in a lot of places around the world, which is interesting because in many cases, bonds were trading at zero and negative yields. And so you have to start thinking, I mean, there was a few days where this happened in the fall time where I said, stocks were down and bonds were also down. And if you get to a scenario over the next 5 years, particularly if you're an advisor that owns funds and charges a percent or whatnot, there's almost no possible way to own bonds and have a positive return. Now, they may hedge if they go hard negative for short periods, but essentially there's almost no way to make any money. So really you're only betting on the deflationary environment. And even then, once you get negative, your return possibilities are even worse, but you have to consider it. So let's do a few more fun polls to think about, put your mind in the right place. No one wants to invest in emerging markets. They've been garbage the past 10 years versus the US. And so we like to ask people, just for perspective, when you think of emerging markets, what percent of the world's GDP do you think they represent? And so in this poll, you can see that most people said 20 to 40%. So 0 to 40%, excuse me, 20 to 40% and below 20 was 70 odd percent, over 70% in the answers. And the reality is, correct answer is 60%. US is only a quarter of world GDP. It surprises people. Emerging markets' current market cap is 12%. So as a percent, if you just straight up index the world, you should have 12% in emerging markets. What's the average that most US investors have? 3. And on average, the valuation discount is over half to the US. So emerging markets in the low teens versus the US, which is at 33. So if you look at the opportunity, and this always sends people into a tizzy on Twitter, I put 100% of my 401k and my son's 529 in foreign and emerging markets for this reason alone. And I'll just keep dollar cost averaging in every month and be extremely happy about it. But this dislocation, and this doesn't even mention demographics of the African continent, of certain emerging markets. And so, these things play out over long time periods, but I'm super romping, stomping bullish on emerging markets, particularly emerging market value over the next decade. What else we got? Here's a fun one. It was touching on people's moral belief systems. And so I said, look, would you invest in tobacco stocks? And it was about almost half, 60-40, 60% yes. But then I said, would you invest in tobacco stocks if you knew that they were going to beat the S&P over the next 10 years? Then everyone said yes. So it's an interesting takeaway on the ESG that people have this morality slant but only if it doesn't cost you returns, which I think is a big challenge for ESG, because as a quant, by nature, you're narrowing your universe. And many of these companies, like tobacco companies, potentially have, I think right now, excellent prospects going forward. Low valuations, high yields, cash flow, just compounders, but fun to note. Here's another quiz. This one's a few years old. It said, do you currently own US stocks? Almost nearly everyone said they did. Then second, I said, would you continue to own US stocks if the valuations, 10-year P ratio, so average over time is around 17, low inflation, call it 22, we're at 33. I said, what if they hit 50? That's actually higher than the highest it's ever been. I said in the tweet this happened before because I was rounding up. It was like 45 at the peak of the internet bubble. 45 or 49, I can't remember. I think it's 49. Still, most people would still own stocks, which to me is insane, but okay. There's no possible way in my mind that at a P ratio of 50, you're going to have positive returns over the next decade. But then I said, how about they go to 100, P ratio of 100, which is near where Japan peaked, I think at 90, again, high 90s in the 1980s. And again, it's taken them 3 decades to just get back to even. Would you continue to own US stocks? And a third of people said yes. This is crazy to me, but it's interesting, this passive crowd that would be totally valuation agnostic. And I bet if you said, scratched out stocks and said, your house, how many people would continue to do this, or your car, or whatever, something that you value, baseball cards, I don't know. They would have a different approach. Here's another fun one. Everyone expects bonds to be risk-free, right? Risk-free rate. So I said, okay, what happened if you invested in government bonds over the past 100 years? What was your biggest loss after inflation? Everyone assumes it's nothing because they think in nominal terms. So before inflation, so everyone says 0 to 20, 20 to 40. So you're up to 60% of people think it's sub 40. Answer is, as Jim O'Shaughnessy chimes in, gives away the answer, Jim, almost over 60%. You lost at some point. There's a good companion article to this we wrote this year called The Stay Rich Portfolio. I highly recommend it. Walks through the concept of not putting your cash in short-term bonds or the bank, but rather investing it in a global portfolio of stocks, bonds, and real assets. And it demonstrates that across every measure of risk, loss, maximum drawdown, 12-month loss, volatility, you're almost always better off investing about half of your money rather than keeping it in safe cash. And this is for the safe cash bucket. This isn't for your an investment bucket. Fun article. It will cause you to see things in a slightly different light for sure. Ooh, here's a fun one. A lot of people will email, call me. We have 12 funds, so we always have something that's doing well and doing poorly. They say, Meb, I allocated to this, that, and the other. It's not doing well. I've owned it for 3 months. I'm going to give it 3 more months, see how it does. Maybe they'll say a year. And they say, how long should I give it? I asked a question to people. I said, how long would you give a portfolio manager underperforming before, how long would you tolerate it before selling? Everyone says 0 to 3 years. That's the time frame they operate on. Crazy people said 3 to 6, and then a tiny minority, 15%, say 6 to 9 or over 10. Why do I bring that up? And the same people say that stocks versus bonds. How long would you, what stretch of underperformance would you be willing to tolerate? So again, a tiny minority say a really long period. Well, the answer is in 2020 at one point, stocks had underperformed bonds, long bonds for 40 years. Not 5, not 10, not 20, 40 years. And so people's time horizons on their expectations, again, they're expecting those 15% returns. They want them now. They want big returns. They want them now. But that's just not the history of markets. And so a lot of people, when you mess up those expectations with potential reality, is where they behave very poorly. They can't take it anymore. They sell everything, rinse, repeat. This happens often. Internet bubble, 2008, 2020, people sell and they never buy again. And these sort of problems, by not having a written investing plan, not knowing the history of what's happened in markets, is why you get in trouble. We did a fun article along the same lines, though, thinking about portfolios, expectations as we're going to the election. This is actually a carbon copy of an article we wrote 4 years ago, and said, everyone's going crazy about election. Pick your side. I don't care which. It feels like a shark or a lion. And I said, people are scared of sharks and lions, but the reality was that sharks and lions actually kill very few people. Sharks are like 10 a year. Lions are only 100. granted, you got to live somewhere lions are. But what should you be afraid of? Look at this chart from Bill Gates, and it shows the thing that kills the most people are mosquitoes. No one's really scared of those. Second most is humans. We're the worst. Snakes, that's fair. Snakes are terrible. I hate snakes. But the next 5, you got man's best friend. And then the next 5, you literally have never even heard of: flies, bugs, snails, worms. And how many people are scared of those? Well, no one. The point being is that when it comes to the election, everyone spends all their time thinking about the election. What should they be concerned about? For most people, it should be the 2 boring things, the 2 probably the most single determinants of your returns the next 20 years, how much you pay for the portfolio and the taxes. But people rarely think about that. And let me give you an example. Here's a chart of ETFs. These are asset allocation ETFs versus mutual funds. And these are static, strategic asset allocation, not tactical, not managers moving around, just essentially buy and hold. And, there's about 10 billion in ETFs that charge less than 0.5%. And ETFs by definition are more tax efficient than mutual funds. Mutual funds that charge over 0.5%, these legacy funds that your parents and grandparents and great-grandparents own, that charge more than 0.5% are $1 trillion. $1 trillion versus 10 billion. You can't even see the ETF slice in this chart, yet people continue to own these mutual funds that are expensive and tax inefficient. I estimate a taxable account, they're costing you about about an extra percentage point more in costs per year, maybe even more. It might even be closer to 1.5 in both extra fees and extra taxes. A lot of people don't know that. They're just lazy, and the inertia of where you have your money, not moving it, is a bigger cost over the long run than actually what you invest in. And it's even worse outside the US. This is in the US. Outside the US, we have the lowest, it's hard to see this, but this is asset weighted expense ratios for allocation funds. US is the cheapest. And then in most of the world, people are paying 1, 1.5, 2. Canada, Germany, India, China, Belgium. I mean, it's awful. Europe. And again, so this concept of low cost is more important in tax efficiency than almost anything else in your portfolio. As a checklist, at its base case, Christine from Morningstar was tweeting about this. She said the JP Morgan tax-aware stock fund, so by definition, it's trying to be tax efficient, is doing a 10% capital gains distribution. And this is supposed to be tax aware. The year prior, distributed 6%. And if this is too confusing or nerdy, by the way, for the investors listening, it's like 2/3 of the average mutual funds do taxable gains distributions, and about 6% of ETFs do, 10 times as many. So your default in 2020 should be you do not own stock mutual funds and taxable accounts. Like, that's the default flow chart. Is it apply for everything? No, but it should be your starting point. People are starting to wake up to this. Let me give you an example. DFA recently came out and said, we're converting some of our mutual funds and ETFs. And this is a big admission, by the way. One of the world's biggest mutual fund companies, they get it. They understand. If you're a mutual fund company that is not either converting or partnering or buying an ETF company, I think you're going to be left in the dust and toast 10 years from now. On top of this, a lot of people don't know this. I asked this today. I said, did you know that ETFs can actually have a negative expense ratio? And most people have never heard of this. But if you're a fund company, this applies to mutual funds too, though. But a lot of fund companies don't do it, or they keep some of the revenue. You can do short lending on some securities. So if a short seller wants to borrow my GameStop, I can lend it to them, and they're going to pay a lot for that. And the good guys like us and others will return that revenue to shareholders. And so this can be a very material source of revenue, by the way, not just say 0.1%. In some cases, it can be over 1 percentage point. Some cases, it can be hundreds of basis points, multiple percentage points. And so you could actually have a fund that, say, charges 0.5%, but if it gets 0.75% back in short lending revenue that it returns to the investors, you actually have a fund that's paying you to own it. How cool is that? Amazing. 2020, right? Most people don't know this. It's an important takeaway to be included in this whole concept of fees, taxes, and expenses. Even worse, though, this history of mutual funds, and I'm sure this applies to ETFs too, and why you need to think. There's an old article we did called "Nobody Wants to Invest in Your Shit," which talks about, there's tens of thousands of funds out there. And a simple, flow chart is, does it charge over 1%? Put it in the garbage pile. Doesn't mean all 2% funds. I mean, there's plenty of hedge funds that I would love to pay 2 and 24, medallion. But as a general rule, it will save you more times than not. Over the last 10 years, guess what? Almost half of US stock funds are no longer around. So this industry, which just throws all these spaghettis against the wall, they want to see what sticks. And most mutual fund managers do not invest a single dollar in their funds. So Wall Street designed to sell you these hot, shiny products. This year it's SPACs, but many of these funds, are not worth investing in. But let's say you're crazy, you want to start an ETF. Talk to Wes. Don't listen to me. Don't email me, I should say. Email Wes. Tell him Meb sent you. He'll give you a deal. We did a whole podcast on this concept of launching an ETF. It's over an hour. I think it's an hour and a half. We're not going to talk about it here. But if you're interested, late to the game, or just want to understand how ETFs work, check it out. It's a great podcast. Anyway, when it comes to this topic of investing, of year-end reviews, of what's going on, the sexy stuff, the fun stuff we talk about, hey, there's opportunity in energy and value and foreign and emerging. Most people should have a written investing plan, and most people should stick to it and have a long-term time horizon, 10 years. And we said, most investors want to be Nostradamus, going back to the prediction at the end of the year, when they really should be Rip Van Winkle, thinking in terms of just being super lazy, super slothy. We asked people, said, how much time, and this is non-pros, how much time do you spend on your investments per week? And most people said up to 10 hours, and there's another 20% said 10, 20 plus. And look, if this is your hobby, God bless you, it's fun, great. The reality is that time is wasted. We did an article called The Best Way to Add Yield to Your Portfolio. The decision to save and invest in the first place is vastly more important than what you invest in or anything else. So the amount you save, when you start saving, younger the better, and getting it invested in the first place is more important. You should spend no time, I think, on public markets. Set up an automated program, lots of all-in-one ETFs, and then just be done with it. And then you can just play around on the edges, of course. And if it's your hobby, great. You can watch me pick fights on Twitter. But in general, that time would be better spent, working harder, finding a new job, negotiating a raise, spending time with your family, playing golf, whatever it is you like to do, rather than research investing. And unless you have more than, I think the inflection point was like $20 million, this attempt at increasing your yield is a total waste of time. What's next? Now, it's not just little guys, by the way. We pick on Calpers too. They're looking for a new CIO, and it's just been this massive drama over the past decade. Not just Calpers, Harvard and others. And we've consistently said, and we wrote an article, should a robot be managing Calpers' portfolio? And they pay these massive amount of fees for the manager, for all their underlying managers, the complexity, hundreds of employees, all this stuff. And we demonstrated you could basically just buy the global market portfolio and you get Calpers returns. Guess what? It's in a basket of ETFs. You don't have to go through all the brain damage. This applies to almost every institution in the country. Now, why don't they do it? I don't know. They like the idea of complexity. There's a lot of career risk. We had an endowment that we were going to talk to. And I said, look, I'll do it for free. I guarantee you I'm going to only be the only request proposal that will do this for free. I'll buy you a basket of 20 ETFs once a year. We'll rebalance it, and that's that. But they don't want that, right? They actually want to pay someone like a Goldman or a Russell. It gives them a false sense of security. Will the results be any better? I don't think so. And I think most institutions should be put on autopilot with a low-cost ETF portfolio. I actually think that'll be a trend you'll see in the next decade. Will Calpers hire me? I doubt it, but we'll see if they reach out. We're going to do some quick hits now and wind down. These are all important, but a little different. There's a topic everyone's talking about crypto, Bitcoin now. There's been a lot of talk of treasury assets, meaning companies buying cryptocurrency as a percentage of their cash balances. Most people tend to just invest it in CDs, short-term T-bills or something. Jack talked about it, Michael Saylor, MicroStrategy. We actually wrote a paper 4 years ago talking about a similar topic, which is hedging your company risk. In this case, they're trying to hedge purchasing power, which again aligns with our concept of having to invest part of that balance sheet. But they're doing it with crypto. We talked about it with global assets. A more interesting idea that we talked about, particularly for financial advisors, is investing your treasury company assets in tail risk sort of strategies. You shouldn't be allocating to stocks in your own portfolio in addition to what your revenue is exposed to, your clients are exposed to, on and on. It's a fun paper. It's called Worried About the Market. Maybe it's time for the strategy. Download it, talk about it, this concept of tail risk. Won't spend time on it. Another fun tweet. We did this talking about Buffett this year in April. I said it's going to be fun to watch people lose their minds when Buffett wasn't backing up the truck to buy a bunch of other companies, but rather just buys his own stock this year. And sure enough, fast forward to November, guess what Uncle Warren was doing? He said, I'm just going to buy Berkshire. This is a better deal. Record amount that he's been doing buybacks. This is also, I'm sure, going to inflame all the buyback haters. But Warren gets it. He's one of the few, Warren Buffett, not Elizabeth Warren. He's one of the few that really get corporate cash spending, buybacks, dividends. They don't pay a dividend because he knows it's tax inefficient, would rather do buybacks. And who understands better than Warren Buffett? Again, this applies to stock selection too. You guys know I love shareholder yield better than dividend and value approaches, one-off. But this is a great real-time example of how Warren thinks about it. A couple other quick hits. I said this the other day, and this is actually even better than ETFs and a taxable account. Now, granted, you have to be accredited and invest in private investments. Accreditation rules are getting better, though. At least do some research. I don't want to spend much time on this, but this concept of QSBS, Qualified Small Business Stock, Section 1202 of the tax code, is such that if you invest in a company that has less than 50 million in gross assets, and you put in money and you hold it for 5 years, you pay no capital gains on the first 10x, not 10%, not 100%, 10 times your money gain, or $10 million, whichever is greater. If you build a basket of private companies and you can at least match the S&P or come even close, you have the ability to essentially pay no capital gains taxes. Let that sink in. No one's heard of this, but it's something that you should actually look into. Maybe we'll devote a podcast in the future to the specific. We talked about it a few times, Alex Rubakova podcast and others. Here's another idea to save you a ton of money. We did a podcast with Doug Ludlow of Main Street. This is really fun. Doug built this killer company. I invested in it because I think it's transformative, where they go and you send them your tax returns, your QuickBooks. They'll do a free audit, and they'll tell you if you're eligible for government incentive programs like the Earned Income Tax Credit, R&D credits. They started out with just a few credits, and they're going to be in the year with hundreds. They have saved companies over $50 million in 2020 alone. The average company, and these are, by the way, are companies 5 people to 500 people. They may not have a CFO, or the CFO may not be aware of all these sort of incentives. The average company that applies, they save $75,000. This isn't just for CEOs, by the way. This also applies to CFOs. It also applies if you're an employee. You guys want a good way to get a raise or a promotion by the end of the year. Print this out, take this podcast over to your CFO, say, listen to this, apply. And I guarantee you, if you save your company $100,000, $500,000, $1 million, you're going to end up getting a promotion and a fast track. And it costs zero. They take a percentage, small percentage of the overall. And by the way, if you tell them Meb sent you, you save 25% on the processing fees too. There's zero reason not to try this out, by the way. If you're a company, every single person, even if you're a huge company, should try this out because it's free. And we actually wrote an article recently on 6 ideas that will give you sidewalk money, meaning as year end winds down, 6 concepts that will help you save money, where people, and the rules where it has to be zero effort, has to take less than an hour, and it has to apply to almost everyone. And so we walk through it. Unclaimed assets, one of my favorites ever. If you go to unclaimed.org, people don't know this, but all the states have money sitting there that have been unclaimed. It's dividends, it's insurance, you move, it's bills. We have saved investors millions. Don't believe me? You can search my Twitter. I think the biggest fine was $80,000 for one person. We've had financial advisors search their clients and get $250,000 across their client book. I guarantee you're going to have a client for life. You're going to be best friends with your whole family if you find them a bunch of money. On top of that, it's at the government that they don't know they have. Second, we talked about was tax credits. Third is finding yield. Many people in their bank accounts have zero yield. They don't know that you can go to places like Max My Interest or Betterment that will give you a higher return on your cash balance. Again, that's just lazy not doing it. We touched briefly on this concept of investing your safe money, also reducing fees already. There's some places where you can go to do shopping rebates, like Rakuten, used to be Ebates. I've received over $500 in free money from them. It's just a browser extension. You can click on this, you get an extra $40 from my link. What else? There's sites that do refunds for fees. Hey, ask for a raise at the end of the year. No reason not to. If you've done a great work this year, only reason not to is laziness. And lastly, upgrades. Anyway, check out this post. It's called Sidewalk Money. I guarantee you it'll at least save you some money in one of those many areas on the blog. Got about 5 more of these and we'll wind down. Another fun podcast we did was for tailored to financial advisors. It applies to everyone's. This concept of checklists, flow charts, where he started a business called FP Pathfinder, Mike LaCour's, and essentially they develop flow charts for investors and specifically financial advisors that if you get to a topic, hey, should I roll over my 401k? Should I do this? It walks you through it. And I think it's a good refresher, but also good background for a lot of people to check out. Don't miss the podcast with Joel Greenblatt. Everybody knows who he is. Awesome podcast. Ed Altman. I mean, I love these old school guys. Ed came up with a Z-score bankruptcy model in the 60s. Think about that, before big time computers. And he was such a gentleman. He had a great story on the podcast where he was talking about how he and his wife have a tradition that every time there's $1 billion plus bankruptcy, they open a nice bottle of wine. And then even if it's a even really big one, they move on to the fine champagne. He said 2020 has been one of the highest years ever for big bankruptcies. No surprise. He said they've been drunk for most of the year. A little tongue in cheek, but funny. Good book, by the way, reading list, How I Invest My Money. This is an article I wrote and have been writing for years, detailing exactly how I invest my money. You can search it in the 4-part series this year: Get Rich Portfolio, Stay Rich Portfolio, Investing in a Time of Corona, and How I Invest My Own Money. This one's good. It's a little bit different though. It's not as specific on the actual investments. It's a lot more squishy in a good way. What I mean by that is it's very personal. A lot of people can relate to some of these decisions: buying a house, not necessarily the mean variance optimization, best thing to do, paying down your mortgage. And a great quote from John Bogle that Josh Brown talked about in here. He said, life isn't always consistent. But it's a very thoughtful look into a lot of professional investors' lives on how they actually invest their money. Highly recommended. Winding down, here's a great gift from Cullen, our bud, chicken farmer down the road. He had a great tweet: when the economy crashes, but you save the stock market. This poor little baby. But hey, mom's got her champagne. All right, guys, that was a lot. Let's wind down. Again, this is a lot of fun. Check us out at themebfabershow.com. Send us some feedback at themebfabershow.com, as well as shoot me an email. We'll do a few more of these by the end of the year, maybe get together for a happy hour. Thanks for listening, friends, and good investing.